Welcome, ladies and gentlemen, to the session on investing in the Colombo Stock Exchange. Deep value at the doorstep. Sri Lankan equities in 2021. The session will feature 3 presenters and will be followed by a panel discussion moderated by Mr. Ravi Abesurya, the Chief Executive Officer, Candor Group. Ravi, over to you.
Welcome, ladies and gentlemen, for the CSE session, Deep Value at the Doorstep. The session itself will be in 2 parts, where we will have 3 presenters taking 15 minutes each, and then the second part will be a 45 or 35 minutes actually Q&A session. The participants are welcome to send questions to the chat box on MS Teams, and we will do our best to answer your questions. Our first presenter will be Mahesh Udugampala, who will be making a presentation on the Sri Lanka economy. Mahesh is a CFA charter holder who leads the research team at SoftLogic Stockbrokers. He brings a wealth of industry experience, having served at leading investment banks in Sri Lanka as Vice President of Asia Securities and Assistant Vice President at Capital Alliance Holdings. He holds a bachelor's degree specializing in economics and is an associate member of SEMA UK. He has received highest recognition in Sri Lanka for his work at the CFA Capital Market Awards, where he won the Gold Award for the Best Sector Report, Banking Sector. In 2019, the Silver Award for the Best Equity Research Report, and in 2018 at Cal, he was the co-driver behind the team that won the Gold Award for the Best Research Team. In 2019, he was part of the team that won the Silver Award for the Best Equity Research Team as well. Our second presenter would be Sanjeeva Fernando, who will present on the potential for Sri Lanka equities, the market. Sanjeeva is the Executive Director, Research Strategist at CSE Securities Limited. He counts over 13 years of capital market experience and 4 years as a visiting lecturer for the Masters of Finance Economics at University of Colombo. He holds the 2 master's degrees with specialties in economics and marketing. Prior to joining CSE, he worked at PricewaterhouseCoopers, Sri Lanka and Maldives. Our third presenter, Mr. Navid Majid, will do a sector analysis of Sri Lanka equities. Majid is the sector head for construction, energy, manufacturing, and textiles sectors at Asia Securities and has over 9 years of capital market experience. He started his career at Moody's Analytics Knowledge Services and is an associate member of Chartered Institute of Management Accountants. Over to you, Mahesh.
Greetings to all of you, and thank you for having me on this forum. Let me set the stage for the discussion with having an emphasis on the third wave and its impact on the economy. We have seen a continuous rise in the number of cases over the last couple of weeks, starting end April. And while Sri Lanka has seen the number of hospital bed capacity reaching its maximum, we have maintained a lower level of fatality compared to the peers. And if you look at the recovery rates are on an upward trend, which allows more patients to get admitted to these hospitals and to receive treatment. And currently, Sri Lanka is on a travel restriction period of 3 weeks, which was going to lift it yesterday, but that was extended with another week. And if I am to talk about the impact from the third wave, we have seen mobility coming down in the third wave as much as we have seen in the first and the second wave. And if you look at the productivity, which is demonstrated by the electricity generation, we have seen electricity generation at a much higher level compared to the first and the second wave, meaning the economy is getting used to operate within the pandemic. And the corporates as well as the individuals have the necessary infrastructure in order to operate within the pandemic, and hence we are not going to see a major impact on the economy given that this is contained within a month. And if you look at the second wave in comparison with the first wave, we have seen much better productivity, and a lot of people expected the fourth quarter GDP to contract because of the third wave that came in last year October. However, it was the other way around. It actually expanded by 1.3%. And if you compare the second quarter last year with second quarter this year, last year second quarter we didn't have any economic activity happening. The entire country was under lockdown for a period of almost 3 months, and usually in Sri Lanka, April is a festive season, and a lot of most of the people missed out on the April season last year. But this year they were able to celebrate it, because of which we have seen a boost in consumption in the month of April. And the month of April also has seen the highest number of ATM withdrawals in the history of Sri Lanka. And we have seen last year second quarter dipping by 16%. Last year GDP in the second quarter dipping by 16%, which is why we are expecting a positive growth rate for the second quarter this year. And if you look at the private sector credit in the first quarter, private sector credit significantly improved in the first quarter, and we have seen about 112 billion worth of private sector net disbursements, which has been the highest over the last couple of months, over the last 12 months. And we are expecting the financial sector also to contribute much more this year compared to the last year, purely because we have seen an increase in the loan stock of the country by about 10%. And all these financial institutions are going to earn incremental income on this 10%, which is going to be which is going to get added directly to the GDP. And on the other hand, out of the 12 months last year, 9 months were under the moratorium. However, that's not the case this year, and that is also going to add a tremendous amount of value to the GDP. And in terms of our expectations for this year, our base case situation where we assume that the number of cases are going to be controlled within a month or within this month, we would expect a GDP growth rate of 4.2% this year. And the worst case scenario, if Sri Lanka cannot contain the virus, we might see a growth rate of 2.1%, which is still positive given the lower base last year. And also it's going to be an interrupted recovery that we are going to see, because until majority of the population gets under the vaccine, we might see several other waves that could come in. And on the other hand, with majority of the population getting the vaccine and majority of the world population getting the vaccine, we might see people traveling around, and people haven't traveled for almost 2 years, which is going to allow Sri Lanka to earn some tourism income starting December season this year. And if I am to talk about the inflation and interest rate expectations, our expectation is that Sri Lanka would maintain lower interest rates in the next couple of months, and we are not going to see demand-driven inflation coming in because of the third wave. However, there could be some spikes in food inflation because of the logistical issues and supply side issues that have come up with the third wave. However, the bumper harvest that we have seen in April and May is going to negate that impact partially. And although Sri Lanka is hit with another wave of the pandemic, we are not going to see the central bank going and cutting rates immediately. One of the reasons is that for private sector credit to grow at this juncture, it's not the level of interest rates, but it's the sentiment and the effect of the pandemic that is going to drive interest rates. That is going to drive credit. So just because you see interest rates coming down, there might not be an improvement in private sector credit. And on one hand, you have money printing, which is going to continue in the short term, which would have some inflationary pressure coming in. And I don't think the central bank would immediately cut rates that would also exert some pressure on inflation towards the end of the year. And in terms of our expectation on the primary market yields, we are expecting them to continue to be artificially controlled, as we have seen over the last couple of quarters. And on the secondary market yields, our expectation is that rather than the current inflation, it's the inflationary expectation that is going to drive the secondary market yields. So in that case, if we are expecting inflation to remain under the lower bound of the corridor, we might not see a major upward pressure towards the end of the year. However, if we are expecting a major upward pressure on inflation, we might see about 150 basis points or about 200 basis point increase in the secondary market yields across the yield curve. And if I am to talk about the outstanding debt or the fiscal situation of the country, yes, the outstanding debt stock is a concern. However, a robust growth rate and foreign currency inflows in the medium term to long term is going to assist the debt situation of the country. We have seen debt to GDP increasing to 100%, and it is a concern. However, we're not going to see an immediate or an overnight improvement in debt to GDP, but in the medium to long term, we are going to see an improvement with a robust growth rate coming in over the medium to long term. And also, it is very important for Sri Lanka to secure the much needed foreign funding or foreign currency inflows in terms of FDIs, tourism earnings and export earnings. With Port City being the game changer of the economy, we would see that with the incentives, financial as well as non-financial, we might see more FDIs coming in. And I think to be honest, 1.5 billion to 2 billion FDIs coming in is not a major issue for Sri Lanka. We have seen that coming in over a few years back. And with majority of the world population getting on the vaccine, we might see tourism earnings coming in, which accounts to about 4 billion. And 4 billion is very significant for an 80 billion economy. And in terms of export earnings, we have seen the world already getting back on track. After the pandemic, we have seen commodity prices moving up significantly, and some Western analysts are looking at a super cycle, which means that Sri Lanka would be able to improve its export earnings going forward. And securing bilateral lending is crucial at this juncture because we have some debt maturities coming in the next 6 months, and Sri Lanka has already secured about 2.2 billion worth of bilateral credit lines in order to meet these requirements. And if I am to talk about the exchange rate outlook, we are expecting a 10% depreciation this year. If you look at the historical trend, we have seen every 3 years there is a major depreciation that has happened, and this year is no exception. We might see about 10% depreciation. And on the import bill, we might not be able to continue the downward trend that we have seen in 2020. One of the reasons is that out of imports, about 75 to 80% comes from investment goods and capital goods, which the government would not restrict. In case if they do, that might have a major impact on the GDP. And also, oil bill is going to be significant this year compared to the last year because oil prices have doubled from last year to this year. And to summarize my presentation, I would like to highlight that we are expecting a GDP growth of 4%, and the interest rates might stay low in the short term. And securing bilateral lending is key in the short term, and in the medium to long term, it's highly important that Sri Lanka maintains a robust growth rate, and it's important that Sri Lanka secures the much needed foreign currency. And that brings us to the end of my presentation in terms of the economy side of it. Looking forward for the presentations by Sanjeev and Navid. Thank you.
Thanks, Mahesh. Yes. I'll be discussing the key characteristics of the stock market per se, all share index and other S&P SL 20 also. So after getting that macro picture, let's take a step down and see how we see the characteristics changing in the domestic market and how we see the outlook. So this chart essentially speaks about all share indexes performance. That's the blue line that you see. As you can see, there were like two growth phases here. First was immediately after the end of the war towards first quarter 2011. There was a massive growth, as you can see. And then immediately after the first lockdown, there was a massive growth that took place following the correction towards 27th of January this year. Again, then there was a correction, and now it's gradually recovering. So our thesis for the market per se is that last year, that is in 2020, the market earnings contracted by around 8%. That contraction came as a result of COVID's first two waves coming in. So with that taking place, as Mahesh also indicated, during the first wave, there was a complete lockdown, which kind of resulted in minus 16% for GDP during 2020. So as a result, earnings contracting by 8% for the overall market relatively shows the resilience of the market and the listed companies as of now. But still, the market kind of grew around 10.5% during last year. And then this year, we are kind of expecting a 39 to 40% earnings growth. Although you saw a massive jump in first quarter earnings numbers, there was a third wave that took place during late April, which is expected to impact the economy and corporate earnings as a result, including bank impairments as well. So once you segregate the market's annual performance, it goes like this. As you can see, last 3 years have been in the green. So, you know, from 1% to 11% to 12% now in 2020 year to date gives a good sign, despite all the challenges we had from Easter Sunday attacks to COVID, shows at a macro level, still the market is growing gradually. Now, this chart I wanted to highlight. The yellow dots and the orange dot is for Sri Lanka, represent the dividend yields for various countries. So the bar charts represent the EPS growth. So why I had these two together is that we look at, essentially when we look at global equities, we look at growth at reasonable yield. Now growth is obviously represented by your EPS growth, and yield in this case via dividend yields. So when you have markets with decent growth, as you can see, once you arrange it in the ascending order, Sri Lanka kind of stacks in middle when it comes to its peers. So that means decent growth. But if you look at the dividend yield per se, it actually ranks number 3. That is, I think, after Malaysia and Singapore. So in line with Pakistan here, which means we are looking at, if you take a multiplication of these two, that is earnings per share growth into dividend yield, we call it a Gary score. Gary stands for growth at reasonable yield. So when you multiply EPS growth from your dividend yields, if your score is kind of more than 100, you're kind of in the good zone, which is the case for Sri Lanka, 39 multiplied by 3.7. So this we see as a main catalyst for any investor to look at in identifying the potential growth and the hedge it provides for investing, be it external or anything, through the dividend yield. So with that, I would like to move on to the next slide, which highlights the ROE or the return on equity and the valuations or the PER multiples for various markets. Again, as you can see, when it comes to the PE per se, Sri Lanka ranks the second cheapest, that is after Pakistan. But when it comes to ROE, again, it ranks at number 3. Again, you have one of the cheapest equity markets to be bought, and which provides around a decent return on equity at ranked at number 3. So this is the other factor after looking at the Gary score to look at in entering into a market. So why now this obviously this chart talks about regional market growths, and we saw around 10% or 10.5% growth for Sri Lanka during 2020, and year to date it has grown at around 12%. So why it has not picked up significantly on a fundamental per se, obviously I think alludes to the main factor of external uncertainties that prevail around the country at a macro level. So one of the main reasons why we are yet to get net foreign purchases coming into Sri Lanka at a significant way. So, but is this kind of a history repeating for 2021? I'm not trying to conclude here, but there are some characteristics. The bar chart essentially represents average daily turnover in US dollar terms. So as you can see, Sri Lanka's average, if you take the kind of the median average daily turnover in US dollar terms, has been slightly around $5 million or slightly less than that. But last year it was around $10 million, and this year, year to date, has gone up to around $20 million. So as you can see, I have like highlighted in yellow here, 2011 also we had kind of similar ADT, average daily turnover in dollar terms. So kind of a similar characteristic, but one of the key differences, as I will have it in a following slide, is the price to book value, because during 2011, at the mid of 2011, price to book values went above 3 times, whereas as of now, it's less than the book value. So technically, it's less than 1. So that's the bargain, or that's the deep discount or the deep value that we see in the market. And obviously, the dotted line represents the currency depreciation. So the currency has gone from 110 in 2011 to where it is today at around 200, 198, the mid-range. So although we see average daily turnover going up, we again see this as a good indicator, given that ticket size or the size and liquidity are the main concerns with regard to CSE when looking at peer markets. So I think with regard to the ticket size, it has gone up. I think during the panel discussion, maybe I think we will be addressing the new listings and all that. So which means the liquidity factor will also kind of be addressed in a significant way, because we are kind of expecting a whole list of equities to be listed during this year, given the framework laid by the government with tax benefits, etc. So yeah, which means kind of we are kind of positive about this average daily turnover being sustained in the near term, and which will be a key reason for some of the foreign markets to enter, especially if you look at markets like US. They do not deal in markets where the average daily turnover is less than $10 million. So if we can sustain this number by listing more companies with better earnings, I think it will be a key positive for the market in the medium to long term. There are a lot of bars here, but what I'm trying to explain you here is that I borrowed this slide from Mr. Rajiv about the market, we are looking at more foreign clients coming into the country in the near term, but following the macro uncertainties being clarified to investors in a significant way. Because as you see, based on the statistics, what you see here is that the local participation is significantly high as of now, which was kind of the case during this 2011 10-11 period also. So I think one of the key focuses is obviously keeping local participation, but then again going into more big ticket businesses by increasing the foreign participation in the market. So this is going to be one of the key things to be addressed, but then again it will be addressed obviously via macro stability coming in. So where do we see the deep discount? As we discussed previously through price earnings ratios, we have the second lowest or second cheapest market in the region. I would like to take your attention to this graph, which has a lot of line charts, but the highlighted one in dark blue is Sri Lanka. So price to book value was above 3 times during 2011, early 2011, as you can see. And it has significantly come down despite market reporting, market expected to report mid-median growth earnings at around 40% year-on-year for this year. I mean, my 40% number expectation is kind of a conservative number once you look at the first quarter earnings, because we are kind of expecting a second quarter to have an impact on a quarter-on-quarter basis because of the third COVID impact. But then again, so if you look at the overall numbers, 40% earnings growth, consensus kind of stacks in the middle. So we see that is the essential value we see in the market. You can buy into the market. There are some concerns with regard to the external uncertainties, and that I think once that part is addressed, which is likely to be assisted by the recently enacted Port City Bill also in the medium term, we will see some significant net purchases coming into the market, because this chart represents net foreign purchases into the various markets that we discussed now. So Sri Lanka is still in the marginal minus, obviously still ranked at number 4 in the order of net foreign purchases. But then again, we're not interested in the rank per se. I think what we are interested as a market and as a country is this going into the positive, and then the real story being sold to the investors and to given to investors as well. So that wraps up my presentation. Thank you.
Thank you, Sanjay.
Thank you very much, Sanjeeva, and greetings to everyone joining us today from around the world. I'll be taking you through the sector analysis for the Colombo Stock Exchange and talking to you about some of the opportunities we see within these sectors for investors to position themselves. So we'll start by taking a look at the sector breakdown of the Colombo Stock Exchange. So the CSE has 284 listed companies under it, across multiple sectors. So if you take a closer look at the sectors, you'll notice that food, beverage and tobacco, food staples and retailing, and consumer services, which collectively can be categorized under the consumer sector, accounts for about 31% of the market cap. And then under the financial sector, we have the banks and the diversified financials, which account for about 25% of the market cap. And then under the manufacturing sector, we have the capital goods and the materials sector, which collectively account for about 23% of the market cap. Now, we at Asia Securities cover up to 14 sectors and 55 of the largest stocks within this. But given the time limitation today, I will not be able to do justice to all of the sectors within. But my presentation today will focus on the three sectors that I mentioned: the banking, consumer, and the manufacturing sectors. So following on from Sanjeeva's presentation, talking about the market performance of these sectors. So over the last year, we can see that the market performance was predominantly driven by a manufacturing sector drive, and it was also supported by the logistics sector. The manufacturing sector is one of those sectors that was a beneficiary of the increased import controls, while also within the sector we saw certain companies that were direct COVID-19 beneficiaries. The logistics sector was a direct COVID-19 beneficiary. We saw the record high air freight rates and ocean freight rates basically work well for the performance of the sector. Now, if you look at the chart onto your right-hand side, you will notice that several of the large cap sectors that are generally cyclical in nature are yet to see their prices re-rate to levels seen back in early 2020. Now, this is where we see an opportunity for investors to position themselves in the context of an economic recovery where we will see the cyclical sectors starting to benefit. So moving on to take a look at the earnings performance of these sectors. So immediately you will notice the surge in earnings from the logistics sector, which has grown more than 10 times due to a pickup in freight rates. And then also the manufacturing sector, from levels seen back in 2019, we've seen the earnings grow 3 to 4 times due to the import controls. Now, looking ahead, we expect the earnings growth to gradually taper down as we see some of the COVID-19 beneficiaries seeing their earnings growth taper down, and also as some of these import controls that are implemented start to gradually ease. But if you look to your right-hand side, the earnings performance of the cyclical sectors, you will notice that these sectors are still at the very beginning of their recovery. Now, particularly if I would point to the first quarter of 2021, and as Mahesh also pointed out in his presentation, this first quarter was actually a quarter where we saw economic activity return back to somewhat normalized levels, where we saw mobility data show improved levels. So in this context, we saw some of the cyclical sectors performed the strongest in this quarter. So looking ahead in the context of an economic recovery over the coming years, we think that the cyclical sectors will start to see a strong recovery in their performance. So just like we saw with the manufacturing and logistics sector, the surge in earnings was immediately realized by the market, and we saw this reflecting on the prices of these sectors. So just like that, with a recovery in the cyclical sectors also, we think that the valuations are soon to see a re-rating. Talking about the valuations, if you look at the Sri Lankan sectors compared to its historical multiples, you will notice that majority of the sectors trade at a significant discount to their 5-year historical PE multiple. But in particular, I would like to bring your attention here to the cyclical sectors, where we are seeing very high growth potential, while it is also trading at a more than 25% discount to its historical multiple. Conglomerates in particular is seeing a very strong growth potential, but this is also due to a lower base in 2020 because of the impact of the leisure segment. But also we are expecting a very strong performance from the conglomerates due to company-specific projects that will materialize over the next few years that will result in strong growth. So with that, moving on to the banking sector. So the banking sector was one of the most hardest hit sectors in 2020 due to a high level of impairments. So this was reflected immediately in the valuations of the banking sector, as you see in this chart, where the banking sector's performance relative to the other sectors, it has lagged quite a bit. Now, looking ahead, we think that the banking sector has a very strong potential for a re-rating with an improvement in fundamentals. So the key thesis we see for the banking sector is an improvement in its profitability, in its ROE, and also in its asset quality. So talking about the valuations of the banking sector, so the banking sector currently trades at 0.5 times book value, and this basically reflects overdone fears of the short-term economic impact. Now, even having stress tested the banks within for the impairments, we know that the banks continue to trade at 0.6 to 0.7 times on a forward basis, which is a significant discount. Now, talking about the ROE improvement for banks, we think net interest income is going to see an improvement in 2021. This is going to be driven by improved loan growth and also a faster repricing of the loans versus the deposits. And then next, we are going to see impairments also taper down towards the end of the year, adding a boost to profitability. And then we expect non-performing loans also to reduce with strong economic growth and sustained low interest rates. Another factor that will add to the banking ROEs is going to be the increased focus on digital banking. So this has been a segment that the banks have been focusing on over the lockdowns. This segment generally commands a very high margin, so this will also go on to help the banking sector margins. And then we have, in terms of capitalization, the banking sector's capitalization remains very strong, and we see that there is very limited likelihood of any more capital calls in the near to medium term. So this means that we see a very limited risk to shareholders' values being diluted. And then we've also seen the banking tax rate being reduced from 28% to 24%. So this, again, is going to benefit the profitability of the banking sector. So in conclusion, stronger ROEs, strong capitalization, and strong growth is being significantly discounted in the current valuations of the banking sector. And so we do expect a re-rating in the sector. Taking a look at the regional multiples, you will notice that the Sri Lankan banks trade at a significant discount on a price to book value basis compared to the regional peers, while on an ROE basis, the Sri Lankan banks remain quite competitive against its regional peers. And this is similar when you look at it from a PE basis. The Sri Lankan banks trade at an average PE of about 5 times, which again is at a significant discount to the regional peers. While if you look at the growth potential, especially the top 3 banks within Sri Lanka, you will notice that this is quite competitive in comparison to the regional peers. So with that, moving on to the consumer sector. So the consumer sector is going to be a key beneficiary of economic recovery. So if you look at the valuations within the consumer sector, currently the FMCG sector trades at about 13.1 times, which is at a significant discount to its historical valuation of 17.9 times, but also at a significant discount to the regional multiples. So looking ahead, we think that the consumer sector will be a key beneficiary of a rebound in economic activity, as Mahesh pointed out. And so an improvement in economic levels will in turn drive consumer demand and support the consumer sector. Historically low interest rates and fiscal stimulus will also benefit the consumer sector. So the fiscal stimulus, we saw significant tax cuts taken by the government back in late 2019 and in early 2020. So this, we never really saw this materialize into consumer demand because we went right into the pandemic. But I think the first quarter of 2020 was a good indication of what sort of consumer demand will prevail under a more normalized environment. And then we have the government's focus on the agriculture sector and the local manufacturing sectors, which will lead to an improvement in rural income, which in turn we believe will drive consumer demand and consumer spending. And lastly, in terms of pickup in the sector, we think that the FMCG sector within the consumer sector will be at the forefront leading the recovery. So what do I mean by this? So if you take a look at this chart here, you will realize that with an economic recovery, the food retailing is going to lead the consumer sector recovery, followed by the personal care and home care, working our way up to finally the durable sector. So Sri Lanka has different names within all of these categories, so we will eventually, I think, with the cyclical pickup, see all of these companies benefit. On a valuation basis, once again, the consumer sector trades at a significant discount on a forward basis to the regional multiples. You'll notice that the consumer sector trades a little below about 15 times, but if you look at the growth potential, it is quite competitive when compared regionally. So here in particular, the two companies you see at the top, CCS and Cargill's, these are companies that are aggressively pursuing store expansions in line with our expectations that consumer demand will pick up. And lastly, just touching on the manufacturing sector. So the manufacturing sector is a sector that we believe is going to benefit quite significantly from the domestic focus. Now, if you look at the valuations within the manufacturing sector, you'll notice that the construction-related manufacturers currently trade at about 6.2 times compared to its historic average of 8.4 times. And likewise, other manufacturers who are net exporters trade at 7.5 times compared to their historic average of 9.9 times. So compared to their historic multiples, the manufacturing sector is trading at quite a significant discount. Going forward, the ongoing import restrictions will continue to support the manufacturing sector. We've already seen this in 2020, despite having a period of about a 2-month lockdown. Some of the manufacturing sector names went on to perform quite strongly and perform their all-time high record earnings in 2020. One of the factors that benefited the manufacturing sector in 2020 was actually what happened between 2015 and 18, where the manufacturing sector went through significant capacity expansions. But in the years that followed, these capacities were underutilized. So in the context, coming back to 2020, when the import restrictions came into play, these manufacturers had the capacity to go out there and cater to the demand. So this is why, without any sort of capacity expansions in 2020, we realized the true potential of the manufacturing sector. The next point was a quick return of the manufacturing sector following the lockdowns. I think the government of Sri Lanka here provided a lot of support and domestic focus, which helped the sector get back on its feet quite fast. Historically low interest rates is going to continue to support the construction-related manufacturing sector. In particular, we are going to see this support the residential sector. So the current interest rates are lower than levels seen back in 2014, where we saw the housing sector boom. So likewise, we are going to see the residential sector continue to support the construction-related manufacturers. And then we have a sharp cut in tax rates from 28% to 18%. Now, this is not only going to help with stronger dividend payouts from the manufacturing sector, but also for future capacity expansions within the sector, which will lead to a strong, sustained organic growth. Quickly taking a look at where the manufacturing sector valuations stand. So here again, we see that the manufacturing sector names trade at a significant discount to the regional peers. On a growth basis, it is competitive, but we don't see it to be as sharp as the consumer and banking sectors, because 2020 overall was one of the strongest years for the manufacturing sector. So here again, we see potential stocks where investors can yield value. So I did touch on the cyclical sectors, but just on the surface for investors who are looking for a deep dive into these sectors, we've recently published a banking sector and consumer sector report that details the recovery of these cyclical sectors. So in conclusion, we have seen the surge in earnings in the manufacturing and the logistics sector translate to the valuations. We've seen a pickup in valuations. And right now, we are seeing the recovery in the cyclical sector being at a very early stage and valuations being at a very depressed level. So just like for the manufacturing and logistics sector, with the pickup in earnings performance, we think that there should be a re-rating of valuations in the cyclical sectors. So the current valuations provide a very attractive entry point for investors. With that, I would like to conclude my presentation. Thank you. And over to you, Ravi.
Thank you, Navid. I must welcome Rajiva to the panel discussion, CEO, Colombo Stock Exchange. I must again remind participants, if you have any questions, please do not hesitate to put it in your chat box. MS Teams, we will address those questions. Rajiv, I think I will start with you since I want to introduce you also. When investing in foreign markets, investors are naturally concerned about operational risks such as ease of entry and exit, custody, trading, settlement, and repatriation of profits. Can you elaborate on how CSE has overcome those risks and some of your plans to bring trading in CSE even more safer?
Yeah, Ravi. So I'll start with the question about the ease of entry and exit for a foreign investor. Foreign investors have been investing in the market, I think, since about 1990. So we have about 30 years of a very established system where foreigners can bring in their funds through a bank account, a specified bank account called a IIA account, inward investment account through any commercial bank, and make the investments in the capital market. And the investor can take out those funds that were brought in at any time without the need for any additional approvals or any other paperwork. So very easily the funds can be brought in and brought out, plus any dividends and profits or capital gains that have been made on that investments can also be taken out. So we have a fairly good established system where there is ease of entry and exit. The second part of it is that there are no taxes. So there is no tax administration cost for a foreign investor. No capital gains, no stamp duty, and dividends, tax on dividends are also exempt. So in terms of repatriation, entry and exit, there is a fairly good established system. Then in terms of the custody of shares, once again, we have 4 leading foreign banks who are operating within the capital market space, Deutsche Bank, Hong Kong Bank, Citibank and Standard Chartered, offering foreign investors custody services. So that there again, the investors will have the benefit of operating through some established foreign banks whom they are familiar with, and the custody of the shares are with the central depository to that extent. It's a secure means of keeping your shares within the country. In terms of trading, clearing and settlement, again we are using online systems enabling trading and real-time data, and data distribution again through international data vendors like Bloomberg, Reuters, etc., which will enable real-time data to be accessed at any given time. And also corporate disclosure policy, which will enable listed companies to disseminate corporate disclosures through an announcement portal that we use. So I think as far as entry and exit, the system is fairly clear. In terms of addressing some of the risks, particularly in terms of settlement risk, Ravi, we are just in the process of going live with delivery versus payment system. As you know, our market operated on a non-DVP system, and we have now finalized all the arrangements to go live within a very short period of time with a delivery versus payment system. All of the rules pertaining to this system change or the settlement change has been already published to the market, and we are awaiting the final regulatory approvals for the margining model, which will enable us to move and go live with a delivery versus payment system, which will minimize or take care of the asset commitment risk on the part of sellers, which was prevalent in the market. So we are taking away one key risk, particularly from a foreign investor perspective, of addressing this asset commitment risk. A natural follow-up, what we would like to do once we go live with the DVP, hopefully in about a month's time, is to start working on a central counterparty guarantee, which is next logical step, I think, for us to take. There we have 2 options. One is to work with central bank to have a centralized central counterparty system for all securities, including debt and equity, or go on our own and have a CCP for equities. And both options are possible, and currently we are engaging with the regulator to see whether we can go with a CCP for equities, because it's very much faster time to market. Of course, there are a few issues that needs to be addressed, particularly legal issues. the concept of novation, finality, bankruptcy laws, etc., which needs to be addressed. So we are working on that parallelly. So these are our plans in the short term, Ravi.
Next question also I might as well pose to you. Sanjeev brought up this size and liquidity issue in the market.
Yeah.
And we know our market cap to GDP as a percentage is also relatively low compared to even region.
Yeah.
What are your plans to address those aspects to make our market much bigger in terms of size and liquidity?
Yeah, I think if you look at market cap to GDP in 2020, we were at about 19%, and this has increased to about 20%, 22%. So if you look at increasing market cap, there are two ways in terms of increase in prices as well as capital, but I think we are looking at capital. We have now seen the primary market getting reactivated. In fact, this year we had the large IPO, the largest we have had since 2011, which was oversubscribed by 8 times, which was followed soon after by 2 other IPOs, which were also oversubscribed. And in fact, today, one started trading today, and of all those 3 IPOs we had, they have traded above par, which is also a good sign to say that their pricing has been right, I think, in the market. So we have seen the reactivation of the primary market. If you look at the capital raise this year, I think over $660 million have been raised through equity, debt, private placements, and rights issues this year within the first 5 months. And we have already surpassed the entirety of the last year. So the good thing is we have seen the primary market and capital raising getting activated now. I think the environment probably is right because as our colleagues mentioned, the valuations are right for issuers to start looking at the capital market, and I think that process is happening. And yesterday we also saw a very positive announcement by the Secretary to the Treasury, who made an announcement of a state-owned listing to take place very soon, particularly in the leisure sector. That's going to add size and liquidity. So all these measures are going to add the required size, liquidity to the market as well. We also saw a public utility, the Ceylon Electricity Board, coming up with a listed public debenture recently. So which is also indication that state-owned entities are looking for market-based funding. So I think the environment is right, Ravi, for the activation of the primary market, and we are quite positive that there are more in the pipeline. As we speak, we are looking at a couple more listings which are being evaluated. So I think we are quite positive that we are going to see the market growing in terms of size and liquidity with more IPOs and companies coming in.
Thank you, Rajiv. I will move to an audience question now. We saw, actually, I will pose it to Sanjeev.
Yeah.
We saw a tremendous gain during the month of January of ASPI reaching 9,000. Then in February and March, it took a steep correction. Where do you see the index ending by end of this year? What do you think will drive that growth?
Right. Thanks. So I guess one of the key questions that most of the investors in the current market are wondering answers for. One of the reasons that resulted in this big boom during January was that not only in Sri Lanka, obviously across the globe, there was a massive use of modern monetary theory as a result of the COVID pandemic. And Sri Lanka was of the hypothesis, okay, we have gone through 2 COVID waves and technically we are done with that, and then essentially there was like some indication that there will be vaccination coming in because vaccines were announced during November last year. So with all these things in the vicinity, there was kind of positive expectations from a sentiment point of view, and then Sri Lanka has only 3 asset classes essentially, that is equity, bonds and property. As you know, property and bonds did not do much during January or during the first quarter of this year. So essentially, all this money, new money, had to go somewhere. So equities were one of the primary preferred asset classes by the overall community at that time. So that was one. The sentiment was 2. And then as we discussed throughout, valuations, because valuations have come down to a very steep, I mean, there was a lot of value in most of the stocks, which had fundamental underlying earnings expectations. And, we were coming out of -8% contraction in earnings, and then kind of the consensus at that time. We are still kind of maintaining that earnings growth of 39% even as of today. But at that time, obviously, earnings growth expectations for other economies were very low, that have been kind of improved because of some of the economies have kind of controlled the COVID impact. So all these things kind of helped give a positive boost to equities. But then again, whether it's justified fundamentally, it was kind of partially justified, because the point was that, when you have a target price for a stock, as most of the analysts do these days, that's for a minimum period of 12 months or 1 year. But we saw kind of these target prices being achieved during a period of month. So obviously there was sentiment, fundamentals, everything kind of backing things up. But then again, at a given point, sentiment took over from all the fundamentals and then drove the stocks even further. So we were kind of expecting that kind of growth to happen during the year, which we are still positive about after the correction. So this was broadly the reason, I guess, for the January boost.
Thank you, Sanjeev. I have an audience question as well as a question I would pose, because it's the same to Mahesh. We have seen news items about there is 1.9 billion foreign debt maturing in 3 months. Then also 3.9 billion maturing in 1 year. Total foreign debt is 6 billion. Current reserves is 4.4 billion. So we have heard these negative connotations to the debt situation. But yesterday we saw Matthias Mathisen, the Chief Investment Officer of Tundra Frontier Fund, saying he's not too worried about the Sri Lanka rupee depreciation. Where do you think Sri Lanka market is today, given that all stock markets have at some stage been frontier markets?
So let me answer the latter part of your question in relation to the frontier markets and the exchange rate. If you look at most of the frontier markets, at one point they have seen a spike in the depreciation at least once. And as you said, more of these investments which are over long-term investments which are over 5 years are going to have minimal impact because of the depreciation. So what happens is when you see a spike in depreciation in a year or two, but when you have a longer time horizon, that's going to get averaged over the longer time horizon, which would have minimal impact on the returns. But however, if you look at a short-term investor, ideally an investor who has a investment horizon of less than 2 years, there may be some impact that would come in because of the depreciation. But there are ways in which this risk could be mitigated that I'm not going to talk about right now. But if I am to talk about the current debt situation, as you mentioned in the first part of your question, I would say yes, right now the current debt stock is a concern. We have seen debt to GDP rising to 100%, and we are not going to see an immediate improvement or an overnight improvement in the debt stock. But going forward with having a robust growth rate and having more foreign funding inflows, we are going to see an improvement. Why I'm saying this is because this is not the first time that Sri Lanka has seen this kind of debt to GDP levels. We have seen 2003, 2004 having a debt to GDP level of over 100%, to be specific about 104%. But over about 7 to 8 years, the government that was in power at that point in time reduced it to about 68 to 70% over 7-8 years. So Fortunately, that's the government that is currently in power as well, and that's the strategy. The same strategy is being used right now in order to improve the debt situation of the country. So the strategy that they are currently looking at is basically having a robust growth rate over the next 4-5 years. When I say a robust growth rate, it's going to be a growth rate of over 4%. And in the short term, it's vital to secure the bilateral lending or bilateral funding to meet the debt maturities over the short term. And also in the medium to long term, it's very important that Sri Lanka secures these foreign funding inflows in the means of FDIs, tourism earnings and export earnings. So with Port City being the game changer of the economy, we would see more FDIs coming in. And with the incentives, it's not just the Port City, there are other economic zones that are in place. There is a pharmaceutical zone, there is a fabric zone in Eravur and an industrial zone in Hambantota. So all of these are going to contribute in the medium to long term in order for Sri Lanka to have some foreign funding. And having foreign funding is going to improve the balance of payment. And indirectly, it would improve the dollar liquidity in the country, which is going to answer your question in terms of the exchange rate, which would have a more stable rate over the medium to long term. And not only that, this improvement in liquidity, forex liquidity, is going to allow the central bank to build its reserves in the long term, which would allow the central bank to have a more sustainable level of debt in the medium to long term. But it's not going to be a overnight improvement that we would see.
Can you put the next questions? I think we have answered these questions. So there is another question on Rajiv, I think,
yes,
about the broker commission. Can we see a reduction in broker commission to promote retail investors?
Yeah, Ravi, just a small correction before I start. I think I mentioned capital raise, it should be $300. It's in rupee terms, I said 600, it's 66 billion rupees, but in US dollar terms, it's $300 million that have been raised so far. So just a small correction. Brokerage commission, yes, I think comparative to some of the other peer markets, our commission rates are higher. But again, we must look at it in context. Sri Lanka is a niche market, and we offer special things to foreign investors. So therefore, I think the rates have been comparatively higher. We need to again see it in context in terms of us reducing the brokerage commissions in terms of the overall turnover and volumes as well. So it has to go in tandem with that. I remember there was an instance back in 2010 where turnover spiked, and we had very high levels of turnover, and everybody thought that was going to be the new norm. And very quickly, rates were reduced. Even the stock exchange reduced rates, and very soon we saw settling down of the turnover again. So I think we need to be mindful of a sustained volume before we can ask brokers to reduce, because end of the day, the brokerage community also need to make money to reinvest. They need to invest in technology, they need to invest in research, and we are a developing market. We need that kind of investment coming in from the market intermediaries. So we are very, on one hand, we are very mindful that commission rates are high, but at the same time, we need to strike a balance where we do it in a manner that we don't affect the investability of the brokering houses as well. So we certainly have that on our agenda, and we will do that reduction at a suitable time, but we still feel that there is more time to do this.
Thank you. I will pose the next question to again Mahesh. Do you think Sri Lanka provides significant diversification opportunities due to the low correlation with other markets, particularly the developed markets?
So I think yes, if you look at purely from the mathematical perspective, I would say yes, our correlation with developed markets as well as frontier markets, it's pretty low. And that's from the mathematical perspective. But if you look at if you look at, on the other hand, Sri Lanka's resilience, Sri Lanka has been pretty resilient to external vulnerabilities. If you, for example, if you look at the global financial crisis in 2008, most of these frontier markets got affected and they saw a massive economic downturn. But then again, Sri Lanka didn't have much of an impact. So that provides some diversification to foreign investors. And on the other hand, if you look at certain global events, Sri Lankan market sometimes does not react much to these global events, and or maybe they will react with a lag. So basically, for example, if you look at the increase in commodity prices, if you look at aluminum prices moving up, we might not see a major reaction or a real-time reaction in the Sri Lankan market, but most of these frontier markets are moving real-time with these changes. And Sri Lanka not reacting real-time would of course provide some diversification for these foreign investors. To overall, yes, I think there is a significant diversification benefit for foreign investors.
Thank you, Mahesh. I will next turn to Naveed. I think there is a question which you can also answer in addition about low price to book value, basically because of bank shares. And I will combine with that question, out of the three sectors you mentioned, what is the sector you are most excited about?
Right. So I'll answer the audience question first. I think they're talking about the market price to book value here. I think surely the banking sector's current valuations do contribute to the market valuation being down, but I think across all the sectors, something we see is that these sectors are trading at a significant discount to the historic valuations. So while yes, the banking sector is also contributing, I think it's across all sectors that you are seeing valuations being quite depressed. And with that, Ravi, coming back to your question on which sector I am most excited about, I think if you look at it from a top-down perspective, I think we are going to see cyclical growth over the next 3 to 5 years. So in this context, you are going to see the cyclical sectors see an improvement in their earnings performance, and also in terms of their valuations, you are going to see a pickup. Now, this does not mean that I am negative on the other sectors. I think there's still quite a lot of potential to pick the right stocks in other sectors such as manufacturing and healthcare. But if you take a step back and look at these sectors from a broader perspective, I think the manufacturing sector, like I mentioned, you are going to see the earnings growth sort of taper out over the coming year as import controls are eased, as the COVID-19 beneficiaries start to see their earnings growth taper. In the banking sector, like I mentioned, we are going to see improved ROEs, improved profitability. But I think one of the overhangs that is there on the banking sector is the uncertainty surrounding the pandemic, as we are seeing right now with the third wave. So any future sort of resurgence of COVID-19 can have a near-term impact on the banking sector's profitability. So that's a near-term sort of concern we might have on the banking sector, but I would still maintain my view that the sort of earnings trajectory we have for the banking sector is still upwards. So with that, I think it's difficult not to really be excited about the consumer sector. I think the fiscal stimuluses that we saw back in late 2019 and 2020 never really materialized into consumer demand because of the pandemic. But in the first quarter of 2021, we actually saw this sort of materialize into consumer demand, and we saw the consumer sector players perform quite strongly. We saw a surge in their earnings. So in that context, I think the consumer sector is, I would say, one of the most exciting sectors right now. And also just finally, if you look at it from a very fundamental basis, from a valuation basis, the manufacturing sector trades at about a 24% discount to its historic multiple, the banking sector about 26%, whereas the FMCG and conglomerates trade at around 27 and 30%. So they are at a larger discount to the other sectors. So I would say the consumer sector looks quite promising going forward.
Thank you, Naveed. I turn to Sanjeeva because we have 3 minutes to go. You mentioned that the market is trading at historical low valuations. what will be the yield outlook for Sri Lanka equities, and when do you expect the equity market to re-rate?
Right. Yeah, thanks. So, okay, yeah. So we are looking at price to book value multiples at a decade low. So the yield kind of we are looking at, I mean, based on Bloomberg consensus, it stands at around 3.7% today, which is a decent yield. I mean, I think we are ranked number 3 within the region when it comes to the dividend yield. So kind of what is the outlook, or why do we see, what are the reasons we see to re-rate? Now, the main reason what we see for a re-rating of the stock market is the earnings expectations, because we are coming from minus 8% contraction in 2020 due to COVID, and now we are kind of expecting 40% year-on-year growth expectations for overall earnings. So that's one of the main reasons. And then again, most of the stocks are trading at very low levels when it comes to price to book, or be it even PE multiples. So these are the reasons why we expect market to re-rate. I mean, just to look at balance sheet based companies like banks, insurance, and all those companies, based on 1 year forward earnings, we are looking at kind of them trading at 50% of their book. So when they are offering significantly high ROEs given the tax cuts and all that, kind of we are expecting these to surpass their book values at least during the next 12-month period. So that's one of the key reasons, given that it's a segment that accounts for 50% of market earnings.
Thank you. We have 1 minute to go. I think I will turn last to Rajiva. Any last thoughts, or you would like to conclude by giving some more hints to the foreign investors?
Well, yeah, probably very, very briefly. We are seeing the bull awakening in a sense. So if you look at both the primary market and the secondary market, we have seen increased activity, and it has sustained despite the pandemic last year, and it's continuing into this year as well. We have seen a resurgence in the interest among domestic investors, which has stimulated trading and volumes, which has improved the liquidity. If you look at the turnover velocity, it's at quite a healthy level, I think, historically at over 25%, I think. So as such, we've seen a lot of exciting time in the market. We are excited, and I think it's time for even foreign investors to get excited now.